All right. Well, good morning. Welcome to the Options Roundtable, those of you in the room, and thank you to those watching online. My name is Jamie Selway. I'm the Director of the Commission's Division of Trading and Markets. Today, we are shining a spotlight on the option market, which often gets lost in the shadow of its bigger and older brother, the equity market, but today we'll remedy that a bit. We've got a very impressive group of experienced options practitioners, academics, and folks to join us today. I would like to start by welcoming our commissioners, Commissioner Ueda, Commissioner Peirce. We'll start with remarks from them. Commissioner Peirce, I believe you're up first.
Thanks, Jamie. Welcome, everyone. This is a great morning. I'm very excited about this Options Roundtable. Thank you to all the participants and to everyone attending either in person or online. And thanks to the Commission staff who made this happen. I am also very grateful to the people who submitted comment letters. We have a written comment file for this roundtable, and we've gotten some really productive submissions with problems identified and potential solutions and recommendations. So thank you for that. And for those of you watching, feel free to weigh in by submitting your own written comment. I do expect the discussion today to be informative and entertaining. After all, even the terminology in the options markets is fun. Butterfly and condor spreads. I mean, how can you beat that? We don't do that in the equity markets. So as Jamie mentioned, despite the fact that the options market is so intriguing, the equities markets tend to overshadow the options market in the Commission's time and attention. And so I think that it's good that we're remedying that today. As we have been writing and rewriting Reg NMS for the equities market, the options market has grown enormously. That growth has not been just in notional value or in volume, but also in participation and sophistication and in the role of the market within the broader capital markets. Because of the importance of this market, a persistent item on my wish list when as commissioner has been that we have a roundtable. And thank you, Jamie, for making this wish come true today. But should I, who is someone who generally thinks about markets as perfectly capable of functioning on their own with very little regulatory oversight, be inviting oversight of the options market? While the equity markets have been pushed and pulled by the detailed mandates of Reg NMS, the options market has had more space to develop its own solutions, sometimes with gentle nudging from the Commission. And we're not here today because the options markets are failing. We're here because they're succeeding. We want to ensure that the options market continues to function effectively as trading and participation reaches new highs. The Commission's role is to ensure that the plumbing is sound and that the playing field remains open to competition. As we'll hear today, the growth in the options market has been impressive, but it has brought with it some matters worthy of consideration. For example, we've seen a proliferation of exchanges, there's soon to be 20, which raises the question of whether we're fostering competition or fostering more market fragmentation, added cost, and greater complexity. We've seen a notable reduction in the number of clearing firms, which raises concerns about resiliency and capacity. We have seen a concentration of activity in a few market makers, which, combined with the cost of connecting to numerous venues and quoting across millions of options, raises concerns about competition and barriers to entry. We've noted the proliferation of strikes, the limited interest in many of them, and the attendant consequences to the market, its infrastructure, and its participants. We've heard from some industry members that generous market maker allocation formulas established years ago to incentivize liquidity provision may inhibit competition and may no longer be necessary in the current market landscape. We've received calls for more transparency with respect to options market data. And of course, as with many of our markets, we've heard of both the opportunities and the challenges associated with 24/7 trading. and tokenization also. I look forward to a lively discussion on all these topics and more, and unlike the Commission's recent roundtables on the equity market, which have focused on how the Commission can undo the damage it caused through its own Reg NMS heavy-handedness, I anticipate that the solutions that will emerge from today's discussion will be industry-led, with the Commission providing playing a supporting role. The recent changes to the methodology of the options regulatory fee, which charmingly is referred to as the ORF, are an example of such a solution. Under the previous methodology, the ORF permitted an options exchange almost limitless ability to charge regulatory fees, even for transactions that occurred on other exchanges or involving a product that was not traded on that exchange. This ability, akin to the state of Maryland being able to charge a toll on your car when you're driving over a bridge in Texas, helped to encourage exchange proliferation. A year ago, when I attended the Options Industry Conference, many doubted that this problem could ever be solved, yet less than a year later, all the options exchanges have submitted rule changes limiting their ability to assess ORF fees on transactions that are not executed on their own exchange. I want to congratulate the industry and our staff in trading and markets on the welcome change. Special shout out to Richard Hawley. I hope that the discussions today will lead to similar solutions in the options market that facilitate its growth, foster its resilience, and continue to support innovation that serves investors well. Thank you all.
Well, good morning, everyone, and thank you, particularly to our staff in the Division of Trading and Markets, as well as the other staff at the Commission for organizing this roundtable and options market structure. Many thanks also to all our participants here today who have taken the time to join us and prepare for this event. We look forward to hearing your thoughts. For as long as I can remember, equity market structure, and to a lesser extent, fixed income market structure, have taken center stage at the Commission in our public and regulatory dialogue. In fact, over the years, we've convened advisory committees in both of those areas. Issues like fragmentation, concentration, data asymmetries, and uneven execution quality have been studied exclusively on the equity side. But data recently released by the Commission makes clear that many of the concerns long debated in equities exist even to a greater extent in options. During the last 10 years, the options landscape has transformed dramatically. Growth in retail participation, particularly in short-dated and ultra-short-dated strategies, has reshaped order flow dynamics, execution pathways, and the economics of being a liquidity provider. These developments should cause us to reconsider the assumptions behind our existing regulations. For example, how does increasing fragmentation, with 15 exchanges with greater than 1% market share, affect the execution quality of retail marketable orders? We should also consider issues in the institutional space, such as the practical effects of market maker entitlements, data asymmetries, and competitive barriers. Do today's institutional market makers still require the types of incentives and entitlements that exist in current floor auction rules? Or has the market evolved to a point where those mechanisms should be revisited? The Commission should optimize regulations for all types of market participants, including individual persons who are often the beneficiaries of the efforts of institutional investors. I look forward to public feedback on how our rules can be modernized to strengthen execution quality, enhance competition, and ensure that the options market can effectively serve investors, institutions, and issuers alike. The data is clear, and the moment is right for thoughtful, measured reform. So I thank Chairman Atkins, as well as the rest of our staff, for convening this options market structure roundtable. Thank you.
So thank you, Commissioners Peirce and Ueda, for your remarks today and for your engagement on options market structure. In particular, I'd like to credit Commissioner Peirce with the idea of this roundtable. Her wish has been granted. Her advocacy and leadership on options helped make today possible, and her intellectual curiosity, her passion for our work, and her dedication to core commission principles regularly make our division better. I also would like to thank our moderators and distinguished panelists for lending us your valuable time, your expertise, and your experience today to help inform the Commission and the investing public we serve. We are confident that this group will lead us through a lively, thought-provoking, and informative discussion about current issues in the options market. Before I begin, please note that my remarks today are provided in my official capacity as the Commission's Director of the Division of Trading and Markets and do not necessarily reflect the views of the Commission, the Commissioners, or members of our staff. This disclaimer also applies to the comments of my division colleagues who will join me as part of today's program. As we explore current topics in option market structure today, it is useful to remember the Commission's last deep dive into the listed options waters was in 2004, a concept release on competitive developments in option markets. The concept release reflected on fundamental questions about how competition, technology, and investor protection intersect in the option markets. It came on the heels of a transformational time for options. Multiple listing standards had been introduced in August of 1999, driving venue competition. The International Securities Exchange, remember that, launched in May of 2000, becoming the first new entrant in the options market in more than 2 decades. Controversy marked introduction of payment for order flow and internalization to option markets then, as execution venues sought to differentiate themselves to customers. Some of the questions raised in the concept release, such as the appropriateness of execution quality disclosure to options trading, remain relevant today. Now, more than 20 years later, the option market has seen phenomenal growth, with increasing retail participation and the addition of more option exchanges, and hence more competition and more investor choice. At the same time, option markets are working harder than ever. The sharp increase in the number of option classes and series and exploding quote traffic necessitate higher levels of technological investment and capital commitment. And despite these transformative changes, liquidity is even more concentrated in a limited set of the most active symbols. Wide spreads are common in less liquid symbols, and large market makers occupy a significant number of specialist appointments, and consolidators control the vast majority of retail flow. Many of the same issues and questions from 2004 persist. It is therefore incumbent upon us to reinform ourselves and revisit where things stand. In our first segment today, we will delve deeper into these trends via data. As we listen, consider that what's old is new again, albeit with a modern twist. As the option market evolves, many of the underlying policy questions with which the Commission and market participants have grappled over the years remain familiar. But today, we consider these policy questions in a landscape that is profoundly more automated, interconnected, and complex than ever before. For example, we continue to consider ways to promote and facilitate competition while addressing any potential negative effects of fragmentation. At the same time, new issues have emerged, such as short-term option series with more expirations during the week. And ORF, as Commissioner Peirce noted. I'm happy to say that in the case of the options regulatory fee, every exchange has amended its rules as part of successful, if long overdue, industry-led reform effort. This reform will move the marketplace to a more equitable and fair regulatory funding model on July 1 of this year. And to the exchange leader who volunteered last fall to participate in an ORF roundtable on December 24, your Christmas comes early in 2026. Today's roundtable is an effort by the Commission to once again engage with market participants in a thoughtful dialogue on these issues and to re-examine and reaffirm an approach that supports transparency, fairness, and competition in the markets that investors rely on every day. We should consider how to respond to changing market dynamics, whether in technology, trading behavior, or market participation, and reflect on our collective past experience and lessons learned as we do so. I expect that today's panel will provide robust discussions that will help us assess these important market structure issues. Today, first, we will hear from Jesse Brady and Ethan Coombs in the Division's Office of Analytics and Research. Jesse and Ethan will present highlights from their paper that was released last week to support today's discussion. The paper is available on the Roundtable website and on the Commission's market structure analytics page. The data describes key trends observed in the options market in recent years. Following the presentation, we will have 3 panel discussions. Panel 1, moderated by division colleague Arun Manoharan, will examine how current option market structure facilitates or hinders the ability of liquidity providers to compete fairly and freely in furtherance of a robust national market system. Our second panel will discuss the customer experience with listed options. Division colleagues John Croper and Eric Juzenitz will moderate. After lunch, Chairman Atkins will make remarks. Our third and final panel will be moderated by Richard Hawley and will consider the growth of listed options, the associated challenges and opportunities that growth presents, and the issues that the Commission and market participants should consider in the years ahead. Again, thank you to everyone participating in today's roundtable. We look forward to exploring with you an interesting and always evolving segment of the marketplace, which is increasingly important to investors. Now bring up Jesse and Ethan for their presentation. Gentlemen.
Should have done that ahead. Okay. One moment, we're having a little audio-visual issue here. There we go. Okay. Sorry about that. My name is Jesse Brady. I'm with the Office of Analytics and Research. First, I want to thank Jamie for this opportunity, as well as everyone else that helped support this effort. It takes a lot of people to put something like this together, and we really appreciate all the assistance. I'm in the Division of Trading and Markets, and today we're going to be talking through the supporting data paper. We're going to pull out some highlights for discussion here. There is more detail available on the paper, as Jamie stated. That's posted on our website. Before we get started, we'll read another disclaimer. Ethan and I are presenting today in our official capacities as staff of the Division of Trading and Markets. This work does not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. The presentation today will follow along with the sections in our supporting data paper, if you're following along with a paper copy. The first section is going to be the options market trends. This really isn't a surprise probably to anyone in this room, but options markets have been expanding very rapidly over recent years. I think Jamie and the commissioners did a great job of summarizing that, but we wanted to put some numbers to that to help further explain this. In 2012, there were around 3,400 underliers that traded any options trade in the year. And by 2025, that number had increased to over 8,000, representing the majority of NMS stocks. Considerable increase in terms of the number of underliers. Additionally, when we look at individual option securities or OSIs, we went from around 500,000 in 2012 to nearly 5 million in 2025. So again, a very significant increase. In terms of the venues where options can trade, we went from 14 exchanges in 2012 to 18 in 2025, with additional ones on the way. When we talk about options market expansion, the conversation frequently shifts to the quote traffic and message traffic, so we'll go over that a little bit here. In 2017, the quote to trade ratio in options was around 9,000 to 1, right, kind of an eye-popping number on its own. But by 2025, that had increased to 17,000 to 1. And what that means in terms of quote messages, in 2017, on the Opera Wire, about 9 billion quotes were going out per day in 2017. And now in 2025, by the end of the year, we were around 131 billion quotes per day, which is a large increase on its own, but there were even more significant peaks earlier in 2025. We pulled a quote from the paper, which I think is pretty impactful. By the end of 2025, the Opera feed was disseminating 3,275 times more messages than it did in the year 2000, or nearly a full day at that 2000 rate, which was around 40 million a day every 7 seconds. I think that it's helpful to put this in context. Now we wanted to compare the increases that we've talked about in the options market, especially on the quote-to-trade ratio, to the equity markets. So we looked at the period 2017 to 2025, and we're showing it here on the screen. The blue line representing the options quote-to-trade ratio, and that aligns with the right axis, Opera quote-to-trade ratio. The red dotted line is the equity SIP quote-to-trade ratio, which you can see on the red dotted line on the screen. As we're showing here, the option quote-to-trade ratio nearly doubled, right, going from around 10,000 to nearly 20,000 over this period. Meanwhile, the equity quote-to-trade ratio was rather stable, starting and finishing near 15. In terms of message counts, what that translates into is that we have Opera message totals increasing by 1,300% over this period. Meanwhile, equity SIP messages only increased by 200%, so only doubling. Despite all this increase in activity and messaging that we've talked about, we also noted an increasing concentration in the top symbols. So the top 10 symbols in 2012 accounted for around 24% of all trading, about a quarter of all trading. By 2025, that had increased to over 30%, approaching a third of all trading concentrated in only the top 10 equity symbols. The concentration we noted was even greater in ETP options. In ETP options, the top 10 products account for almost 84% of total volume. The next section we're going to talk about from the paper is the options market makers. I think the commissioners did a great job summarizing some of the difficulties facing market makers, and we wanted to put some numbers to support those, the hardships that market makers may have been facing. When we look at the count of market makers that reported any focus revenue for options market making, in 2012, we had a total of 98. That number was rather stable until 2015 or so, and then we see a pretty stark decline where we go into the 70s, down as low as 50 in 2021. This is a significant decline in the number of market makers reporting any revenue, much less significant revenue. In the paper we discuss, this concentration seems to be strongest in these small market makers. We will note from 2021 to 2025, we had the rapid expansion in terms of options market growth. However, that doesn't seem to translate directly into the number of market makers, as we see that number does stabilize, but we do not see a material increase. The next section, which is surely going to get a lot of coverage on the panels today, is payment for order flow, or PFOF. Again, we have a couple quotes from the paper here. Aggregate PFOF payments and options now dwarf those in equities due to a couple factors. One being the higher per contract rates, and then additionally the growth of the retail options market. Now, what this leads to is now PFOF payments from options account for 2/3 of all payment for order flow. The next quote we have here from the paper, recent academic research finds that the top 5 payment for order flow providers account for over 95% of the total payment for order flow received by brokerages. Options PFOF is highly concentrated, and the top 3 account for as much as 90% of total payment for order flow. The next section we'll talk about from the paper is market quality and competitive dynamics. The first metric that we get into in this section, and again, as the rest of this presentation, we'll have a little more data. We'll spend a little more time on each slide. The first metric we looked at were effective spreads in equity options. What we see here is an overall decline when we look at all classes. We see that number in 2012 going from 2.2% to 1.9% in 2025. You can see on the far right hand, the change here is about 30 basis points. However, that decline in effective spreads is really concentrated only in the top 10 symbols. The second line here, the 1 through 10, moved from 1.3% in 2012 to 0.9% in 2025, a 40 basis point decline. As we see on the rest of the graph, every other bucket of securities has an increase in effective spreads over this period. Some of these are rather large. If you look at the 101st to 250th underliers, you see an increase of 150 basis points. The next metric we looked at was the trade-weighted quoted spreads in equity options. Again, these were constant for the top 10, going from 1.6 to 1.6, unchanged, but did widen for all other underliers. ETP options also had a very similar pattern of increases. As we see in the table here, on the right-hand side, these changes were also very significant. We have changes going from 110 basis points up to 260 basis points, so considerable increases in that trade-weighted quoted spread. The next section we're going to present on is the customer experience and options, and I'm going to invite my colleague Ethan Coombs up to do this section.
Thank you, Jesse. This next section about the customer experience will examine how customer orders are executed in the options market. This is a sale condition breakdown for customer orders. It shows that over 26% of customer dollar volume is classified as multi-leg electronic, so orders executed in the complex order book. Over 11% of customer dollar volume was multi-leg auction, which are complex orders executed in a price improvement auction. 2.75% of customer dollar volume is classified as other. Many of those orders were executed on options 4. The remaining 60% of volume are single leg orders executed in either the electronic order book or a price improvement auction. On the following slides, we've provided CAT-derived execution metrics for those single leg orders that make up more than 60% of individual customer dollar volume. On this slide, we examined price improvement and effective spreads for marketable orders, the vast majority of which are executed in the electronic order book or price improvement auction. We looked at these market quality metrics across spread widths. For these metrics, marketable means the limit price could execute across the NBBO at the time of first submission to an exchange. Price improvement and effective spread were both calculated on that initial NBBO. For marketable orders, we think price improvement is a particularly valuable metric due to the fact that by crossing the entire spread, marketable orders control for the variable aggressiveness of the customer limit in non-marketable limit orders. The top table shows price improvement, where auctions live up to their price improvement name by providing the most improvement across spread widths. For example, 22% of orders that had a quoted spread between a penny and a nickel executed at a price better than the NBBO. 89% of orders with a spread between $1 and $5 were executed at a better price. Compare this to the electronic book, where we had almost no orders had price improvement with spread widths between a penny and a nickel, and 5% of orders were improved where spreads were between $1 and $5. The second table shows effective spreads for the electronic market and price improvement auction. Let me start that again. The second table shows that effective spreads for the electronic market and price improvement auctions were very similar across the more narrow spread widths. As quoted spreads widen, auctions resulted in lower effective spreads. For instance, when quoted spreads were between $0.25 and $1, effective spreads were 17 cents for auctions and 37 cents for electronic. On this slide, we show the utilization rate between the various execution methods across spread widths for individual account marketable orders. Across spread widths, the electronic order book is used 1.5 to 3 times more than price improvement auctions. Here are the same metrics for individual account non-marketable limit orders instead of marketable orders. Again, we look at price improvement in the top table and effective spread below. We see high rates of price improvement across the board, which is what you would probably expect, given that the initial limit was inside the initial NBBO that is used to calculate price improvement. We do still see higher rates of price improvement for auctions, 96% versus 80% for electronic executions, where the NBBO is less than or equal to a nickel. When we turn to effective spreads, again, that's below, we see significantly lower effective spreads for auctions versus electronic execution in all market widths greater than a nickel. For instance, in markets with a quoted spread of 6 to 10 cents, we see auctions providing an effective spread of 2 cents versus 5 for electronic. On this slide, we show the utilization rate between execution methods across spread widths for individual account non-marketable limit orders. Interestingly, we see our highest auction utilization rate of any bin with non-marketable limit orders and spreads between a penny and a nickel. This is the only bin in our data that has a higher than 50% auction execution rate. Auction usage rates decline as spread widths widen for non-marketable limit orders in our sample. All right. We're going to turn now and talk about trading in options with 0 days to expiration. Options have always traded on their expiration day, but they have grown in popularity in recent years. You can see the growth from 2022 to 2025 here. On this slide, we show which types of accounts are active in 0 day versus non-0 day options. Individual customer accounts, represented by the dark blue, are a much larger percentage of volume at expiration than non-expiry days. Institutional customers, on the other hand, are a much smaller proportion of volume in 0 day options than others. You can see institutional customers in the light blue. Here we looked at the types of customers that traded 0 days in 2022 versus 2025. We find that while it is still disproportionately individual accounts, some of the market share has gone towards other proprietary and foreign broker types. In our final section, we'd like to talk about the types of accounts we see participating in options trading. Here we have the rates of CCIDs reporting any amount of options trading. Despite the options market growth, those rates are still single digit outside of the other proprietary CCID category. In our data, we see the rate of new individual customer CCIDs declining and an increasing trend for foreign CCIDs. We want to note here that foreign CCIDs can sometimes represent an omnibus account with multiple people behind it, so it isn't a perfect comparison to the individual customer account type. Ooh. Jesse, that one's not loading. The chart's not. It's frozen. Let's go. Do you want to just refer them to the paper?
Yeah, that's your last slide.
Okay. This is all planned. From the beginning. Oh my gosh. Should I tell my joke now?
Yeah, do your joke.
I have a joke for my 9-year-old. Why didn't the black hole cry? It pulled itself together. It's from a 9-year-old. You have to laugh or you're bullying a child.
I don't understand what's going on.
It's up there. It's on screen. There we go. All right. Okay. Looking at individual customer CCIDs, we should be clear that we are documenting CCIDs new to CAT, which starts in mid-2021, so the fast fall off at the beginning should be viewed as our data converging to the actual number of accounts being activated. After that convergence is functionally complete, we see the number of monthly CCIDs stabilize before entering a long, slow decline in 2024, which continues despite the record high contract volumes in the options market. I don't want to struggle with it. So, it's up there? Thank you. There isn't a big enough reservoir of pre-existing foreign accounts to have an obvious convergence at the beginning, and we see a clear pattern of growth for most of the period. The highest number of new foreign CCIDs is still several times lower than individual accounts. As staff members, we don't want to speculate on if or when they might pass each other, but if our panelists want to give it a shot, they should feel free. Okay, that's it for us. I want to say thanks for coming here today and for reading the paper. I hope it's helpful and supports a fruitful conversation about the options market.
Many thanks, Jesse and Ethan. Thank you for contending with technology. Better to break closer to the end than the beginning. Panelists, for the first panel, please come up and join us. Arun, also.
Take this and go shoot it.
Just throw it this way.
This is mine.
Wonderful. Well, I'm happy to introduce my colleague from the division, Arun Manoharan, who will moderate our first panel. Arun, you ready to?
I am.
Ready to roll?
Ready to roll. Ready to roll. All right, good morning, everyone. As Jamie mentioned, this is the first panel of three, and it's titled Facilitating Competition in a Quote-Driven Market. We're going to talk about a range of issues today, ranging from market maker guarantees, price improvement auctions, and more. Like Jamie mentioned, my name is Arun Manoharan. I'm an assistant director in the Office of Analytics and Research in the Division of Trading and Markets. I've been at the SEC for over 12 years, and for many of those years, I've worked on a ton of different issues in the options market. And so I'm very excited to be the moderator today, along with Director Selway. And we have a great number of experienced market professionals today to help us with this panel, many of whom I've worked with over the years. And so to kick us off, let's everyone introduce ourselves, starting with Ivan.
Good morning. I'm Ivan Brown, head of options at IEX. Prior to that, I served as head of options and business development for the New York Stock Exchange. I want to thank the commissioners and staff for providing this forum today to discuss important issues in the growing and dynamic U.S. options markets. Given the extraordinary growth in options trading, it's critical that market structure remains well-positioned to support vigorous competition, strong displayed markets, and positive outcomes for end investors. We look forward to working cooperatively with all industry participants in advancing this goal. IEX is proud of its record as an innovator, driving more liquidity and better prices on its equities market, and we're excited to bring that same approach to options later this year. Thank you for having us.
Good morning, I'm Steve Crutchfield. Until recently, I was a partner at Chicago Trading Company, where I was head of business development globally. Prior to that, also at CTC, I oversaw equity options market making for the firm. Previously, I was an executive vice president and head of options and ETFs for New York Stock Exchange. Among a number of other roles there, I was also CEO of NYSE Amex Options. And I should say for the record, my opinions today are my own and not necessarily those of CTC or any other party. Thanks for having me.
Hi, my name is Nathan Duckles. I lead our U.S. equity options business at Jane Street and have helped to build and support Jane Street's options business since I started there in 2008. As a background, Jane Street's a global market-making and quantitative trading firm that's active in a broad range of asset classes around the world. In the U.S., we provide equities and options liquidity as a market maker, as an institutional liquidity provider, and as a wholesaler. By volume, we're one of the largest U.S. options market participants. I'd like to thank Chairman Atkins, Commissioners Person, Ueda, Directors Selway, and Manoharan and Richard Holley and the whole trading and markets team for the opportunity to engage on these important subjects alongside such a distinguished group of industry colleagues.
Good morning. I'm John Fisher, Head of Market Structure and Business Development at Citadel Securities. We're a leading market maker in the U.S. options ecosystem, serving both retail and institutional participants. We provide liquidity on screen as well as across all options trading floors. The U.S. options markets are the envy of the world. Retail participants in particular have never had it better. They benefit from significant price improvement, free commission trading, and access to a wide range of innovative products. That said, there are targeted areas that we believe warrant review. Exchange proliferation has introduced significant cost and complexity to the market. We estimate that small options venues introduce a cost of $200 million to the industry annually. We should also consider introducing Rule 605, execution quality disclosure to options. We should evaluate the role that trading floors play in the options ecosystem. We believe that the value that they once introduced to investors is no longer the case. And we should consider modernizing capital requirements to ensure they're sufficiently risk-based. I look forward to the discussion today.
Hi, good morning. My name is John Kenahan. I'm the CEO of Group One. Group One is a market-making firm that is somewhat unique amongst some of its larger competitors in that we don't have an affiliated arm or related company to wholesale or route order flow. I've been at Group One for the entirety of my career, and I've been the CEO since 2014. I want to thank the Commission for offering us the platform to speak. I think in many ways our markets are extremely well-functioning and thriving, but there's always something new to talk about. There's some old things to talk about too, and I'm grateful for the platform, so thank you.
Hi, I'm Katie Colchin. I'm Head of Equity and Options Market Structure for SIFMA. I wanted to thank the Chairman, the Commissioners, Jamie and Richard, and the whole team for inviting me to join this important conversation today. And I want to thank Commissioner Peirce for some inspiration earlier. Both Jamie and Richard had asked me what animal I was going to come up with for today, and I was struggling until Commissioner Peirce said butterfly. And it dawned on me, despite their small size and their delicate nature, butterflies are actually extremely resilient and adaptive, and that's what the options markets have been.
Thanks to the Commission and the Division of Trading and Markets for inviting me. My name is Stuart Mayhew. I'm the honorary former academic on the panel. I started my career teaching MBAs as a finance professor at Purdue University. I came to the SEC. I was here for 8 years, from 2002 to 2010, where I worked on many of the option SRO exchange rulemaking projects. I was in the Office of Economic Analysis, which is now known as DERA. And options has been the focus of my academic career. It was the focus of much of what I did here at the SEC. For the last 15 plus years, I've been at Cornerstone Research, where I co-head our securities enforcement practice area. I work on a lot of civil litigation matters and internal investigations, but one of the things I do there is assist market participants to evaluate and analyze and comment on proposed SEC rulemaking, including in the trading and market space. So I'm pleased to be here, and I look forward to hearing everybody's remarks.
Hello, I'm Andrew Schultz from Susquehanna. I'd like to thank the SEC and the other participants for including us in this roundtable. I've been with Susquehanna for 29 years, beginning my career as an options market maker on the Amex 4. For the past 15 years, I've served as head of strategic options business development, working closely with our market making and technology teams to prioritize and advance our options initiatives. I previously served on the MIAS Exchange Board, and I currently sit on the NASDAQ Exchange Board. I look forward to discussing these topics today.
Hi, my name's Steve Sosnick. I'm the Chief Strategist at Interactive Brokers. Little background is I joined a firm 30 years ago. I joined this little market-making firm called Timber Hill. I co-managed our options market-making for many years before we exited the business to focus on customer business. To speak to that chart of declining market maker participation, we felt it was better to serve our customers by not wearing two hats. But over the years, I've sort of morphed into a talking head, basically, right? Mostly writing, presenting, things of that nature. Quick thing, I last spoke in front of the SEC at a panel you guys did after Dodd-Frank in New York. When that came in, and there was a panel basically that, sorry.
Welcome back. Let's do better this time.
Yeah, no, so yeah. The talk was, Congress handed us this legislation, can you help us figure out what to do with it? And it was a roundtable of this nature. So I'll let everybody else decide how that went. And so I'm very happy to be here and happy to represent my firm on behalf of this. And thank you to the commission, the commissioners, and to Richard Hawley for putting this together.
Hi, I'm Kevin Terrell. I'm the head of markets at NYSE. I'd like to thank the commission and the staff for having me here today, and I'm very happy to be put on a panel with so many esteemed NYSE alumni. So NYSE operates two options exchanges, NYSE American and NYSE ARCA. We have a little over 21% market share and multi-listed trading volume, and uniquely we have two trading floors in addition to the full electronic offering. In terms of the options industry, we view the industry as fundamentally strong, echoing many of the sentiments already spoken here today, and we think that's really created this the right environment for the phenomenal volume growth we've seen over the last few years. So we're eager to work with the industry on keeping the ball moving forward, keep advancing topics. I think the industry is strongest when it works together and collaborates, and I think upcoming topics like extended hours trading are going to need a lot of industry collaboration, so we're here to work with everyone.
All right, fantastic. Okay, so first we're going to turn to Katie, who's going to provide some context on the options market that will help inform today's discussion. All right, Katie, floor is yours.
Thank you. We thought since this is panel one, it would be nice to set the scene. So some of which I'm going to say everyone in this room knows, but for the benefit of everyone who's going to tune in either live or on the recording of this. So people like to draw comparisons between the options and equity markets, but they have very different market structures. Options are quote-driven markets versus order-driven in equities. So at a high level, and what's going to be important for this panel, this means options markets are determined by those who make the markets rather than by the investors. There's no off-exchange trading in options, whereas equity markets currently trade just under 50% off-exchange. If you turn to products traded, options have between 1.9 to 2 million strikes, depending on the time period you're looking at, versus over 10,000 stocks and ETPs in equities. So that's 188 times more quotes for a market maker to manage. As to market participants, there's been growth in retail participation in both options and equities. While equities has leveled out around 20%, you can think about, depending on how you break this out, retail participation in options is around or above 30%, although if you look at some data that's focused in on the retail and self-directed brokers, they're about 50% of total volume. The next comparison I'm going to make might come off looking more like a similarity than a difference. This is the trading venues. So options currently have 18, soon to be 20 exchanges versus 17, soon to be 19 in equities. So that doesn't sound so different, right? Well, here's the difference. Let's draw a line at a 1% market share per exchange. All of the options exchanges, again, depending on time period you're looking at, are over this threshold. You turn to the equities markets, and 10 out of the 17 exchanges are below a 1% market share, and 7 of those exchanges are less than 0.5% market share. So let's move on to the growth in options. And there's been plenty of growth to discuss. There's growth in volumes. ADV is now just shy of the 70 million contract level, and that's a 260% increase since 2019. There's growth in venues, again, the 18 going on 20. You can get to a similar 260% growth rate if you go back to 2000 when there were only 5 exchanges. But even since 2010, there's been around 100% growth in number of venues. There's growth in strikes. If you think about that 1.9 to 2 million, depending on time period again, that's an over 100% growth rate since 2019. The team presented earlier the growth in messaging, and the number was over 1,300% since 2017. There's growth in products to be traded. So if you look at the SIBO data, there's more than half the volume now. The split has shifted if you split it by less than 1 week to expiration versus over 1 week. Now it's more toward the less than 1 week. And as we saw earlier, 28% of that is 0 DTE. So what does all of the growth mean? Well, for retail, it has produced a positive experience. I'm sure you're going to hear this 50 more times today, but retail has never had it better. So does that mean our conversation ends here? No. First, we can always strive to be even better. And second, growth comes with a darker side too. Let's talk about strike proliferation, which I'm also sure we're going to hear a lot about today. This is also exacerbated by the increase in the number of exchanges. So this means market makers are managing, just looking one-sided, over 35 million quotes. When the other two exchanges come on board, this increases to 39. That's an 11% increase just for adding 2 more exchanges. So strike proliferation is increasing the complexity and the cost for market makers. And speaking of cost, I'd be in hot water with my members if I did not bring this up. We've got costs continuing to balloon. That's data and connectivity fees for every exchange. And of course, there's ORF. There was a Bloomberg article that showed for 2025, ORF cost the industry and investors in the range of 181 to 234 million. So this panel is about competition. If you think about that, what does that mean? When you're making a strategic business decision to either enter or remain in a business, your equation has a cost and a revenue side. So this panel is going to tackle a lot of the revenue decisions. But isn't it time we also took a serious look at the cost side? Could it be that the ante just to get a seat at the table has now grown too high? So markets are evolving. Kevin already alluded to the fact that extended trading is coming to options too. And we should keep asking these questions and analyzing the data to assess the current environment. And that means studying and questioning both sides of the strategic equation, the revenue opportunities and the costs. That is a healthy thing to do. Thank you.
Thanks, Katie. That was really helpful. I'm sure we're going to touch upon all those issues in this panel as well as the following two. All right, for our first topic, let's turn to market maker guarantees. Panelists, from your perspective, how would you describe the states of competition between specialists and market makers? In particular, what effect does the 40% guaranteed allocation, as well as the specialist small order guarantee, have on competition?
Thank you. From Jane Street's perspective, we believe the principle that ought to guide the SEC here is that facilitating competition means that participants that are capable of providing an equal service are on an equal competitive footing. And so we see no issue per se with exchanges choosing to incentivize services, such as quoting uptime or opening quotations with things like small order guarantees or guaranteed allocations. The issue that we see is that the specialist for life model that exists on certain exchanges or non-competitive specialist allocation processes functionally mean that new entrants face barriers that don't exist for incumbent market makers. So we don't think that the SEC needs to take on the task of dictating what the right model is for an exchange, but we do see a lower touch path towards fostering innovation by allowing exchanges to embrace new models for incentivizing liquidity or uptime. One example here would be supporting exchange models where any market maker who can fulfill the same obligations has access to the same rights that a specialist would. So you can have multiple market makers fulfilling that on a single exchange.
Great, thanks, Nathan.
So from our perspective, from the exchange perspective, to us, a lot of this is key to our competition relative to other exchanges. So we're really trying to balance the right incentives and also make sure we're not too stagnant in the way we approach this. And some of the things we've done the last few years is we've taken a hard look at the way we have a process to determine who is a specialist in a name. We have competitive elements to that. We've introduced something last year where we had sort of a check to make sure the primary and secondary specialists on our Amex exchange were truly providing service, truly providing volume, and truly helping our competitive positioning. So I think there's a lot that could be done here. I think just via competition. We have 18 to be 20 exchanges. I think there's enough sort of competitive landscape and sort of exchange capacity in the industry that if there were ways to try new incentive programs, there's a lot of opportunities for people to do so. There's a lot of exchange medallions out there that could do that. We're trying to make sure our model evolves as the competitive landscape changes, and as we've seen a few new market makers enter the space and market makers getting into new lines of business, we're trying to keep the market kind of up to date with what's happening.
Okay, yeah. Yeah, I think it's helpful to set the scene here. So we'll hear many times today that options markets are quote-driven, and specialists are critical to that ecosystem. They have the most stringent quoting requirements of any market maker and any market participant. Also, just to set the stage in additional context, not all options exchanges have specialists. 11 of the 18 options exchanges have specialist assignments, and it's primarily the pro rata venues. In addition, not all market makers choose to be specialists. There are 14 market makers that have specialist assignments today. That is in large part because of the higher quoting obligations that specialists have. So specialists have increased quoting presence time, so 90% versus 60% for other market makers. They have requirements to support the opening for series, and they have to quote a broader range of strikes, including leaps and adjusted contracts. So it's important also to remember that most options are illiquid. That includes in liquid underliers. Without specialists, there wouldn't be screens, or there would be very wide screens in many of these options, which would cost investors. So in return for those obligations, specialists have certain benefits. There's a 40% participation in marketable order flow. That 40% rule exists throughout many aspects of options market structure, including in auctions, directed order market makers, as well as on the floor. Specialists also have the benefit of 100% allocation of orders that are 5 lots and less. I think guarantee there is a misnomer. The specialists must be at the MBBO to be participating on any of that order flow. So at a minimum, investors always get the best available price. Also, any firm or any market maker on any venue, including venues that don't have specialist assignments, can improve the specialist price by 1 tick, and the specialist then gets no benefits. So I think those nuances are very important. The addition to that is directed order flow bypasses specialists. So almost all activity today is directed to a market maker, and when directed to a market maker that's not the specialist gets no advantage over any other market maker. So just to recap, there's significant obligations, and with those significant obligations come small benefits that come after being at the MBBO, after non-directed orders, and only on specialist venues.
I think Group 1's position is, like, philosophically, the market functions better when, there are fewer, like, set-aside guarantees on different segments of order flow. But I do acknowledge that, there are increased burdens for compliance purposes, and also to build on Nathan's comments, like, there are different levels of service that are provided by different market participants too. That has to be acknowledged. But I will also say that in a simple kind of experiment, like, if those market maker guarantees didn't exist, we would make different markets. And my guess is they'd be tighter or deeper, or some combination thereof. I will also say, though, that that's not the only thing that would change. And it's not immediately predictable as to exactly what that outcome would be. You'd see routing behavior change. The price of order flow would probably change. So it would be pretty complicated. But from a strictly simple philosophical point of view, the fewer guarantees that are out there, like my guess is, in the long run, the tighter market you'll have.
All right. So I have proposed with some friends a drinking game. And it's called the Envy of the World drinking game, which is you go to an industry event, and every time somebody says that the U.S. markets are the envy of the world, you have a sip of your coffee. So John Fisher, thank you. It was about 30 seconds into this panel, I think, when we heard that phrase. But I'm making a little bit of a joke, obviously, but it's true. We've got very healthy markets. We've got an excellent customer experience. We saw a lot of statistics earlier. There are many ways to slice pretty much all of them, and thank you, by the way, for that presentation. But it's certainly true that overall we've got a very good experience for investors. That said, Katie said this very well. The competitive dynamics on the liquidity providing side have been skewed through no generally bad action, but sort of through inaction in the natural evolution of markets over decades. It was interesting to me to hear that there was an options market concept release back in 2004. I have to go back and look for that, but it's certainly been some time. So thank you again for having us here today and fostering this discussion. Imagine the counterfactual. Pretend there's no 5-lot rule. So I'm going to mostly talk about the 5-lot rule, which says that specialists, we call them DPMs, various things on various markets, but specialists get all of orders up to 5 contracts if they're routed to them when they're on the quote. Now pretend that rule doesn't exist and someone says, I have a great idea. Exchanges are going to get to pick a market maker in every class based on some opaque process, and then that market maker will get all the 5 lots routed to them whenever on the quote on that exchange for the rest of their lives. And then there's something about quoting obligations, which I'll come back to in a second, but basically that's the story. If somebody suggested that in a world where we didn't have that, I think precisely nobody would say, that's a great idea. That's a market structure that we should have. So my view respectfully is I think all the arguments you hear in favor of this are either status quo bias, which is we all have it, including me, but we're used to this thing. It seems normal. Oh yeah, we have 5 lots. Or a little bit of self-interest, or maybe a little bit of column A and a little bit of column B. So as was alluded to briefly earlier, the reason we have specialists in the first place, or at least going back several decades, I started my career in the floor of the CBOE as an intern in 1997, they only had what they call DPMs in a very small number of issues. It was the most illiquid classes where there was not enough natural liquidity provision from market makers who have an incentive to make a two-sided market for customers to have a good experience. And that made a ton of sense. And by the way, it's entirely appropriate for an exchange to be able to say, we really need help in this name. We're going to give you some special incentives to provide liquidity in this name because the natural liquidity on the screen is not sufficiently healthy. And that's where the DPM, the specialist system came from. That's where the 5-lot rule came from. It was one of those incentives. But I would respectfully submit it makes 0 sense today in a Tesla, NVIDIA, and Amazon, and Apple, or any of the top 1, 2, 3, 500 symbols where competition is intense among market makers electronically beyond anything that CBOE or anyone in the 90s would have envisioned. A DPM appointment in a name like Tesla provides precisely 0 marginal market quality while awarding a massive benefit that then sits with that party essentially forever. So the effect that has on competition, it's stifling. I respectfully would say I think John Fisher is completely mistaken in saying that the reason parties don't get DPM allocations is because of a heightened obligation. The obligation is not material. It's some market with in a higher percentage. Most of us who have electronic market making systems, you can turn a knob in your system, you can meet that obligation. The reason more market makers don't go after these DPM allocations, number one, is we can't. I can't just sign up and say, I want to be the specialist in Apple now on the CBOE. Somebody already has that appointment, and they're not going to lose it in the next decade probably unless they screw up or sell it. 2, there's no benefit to having that appointment unless you have the order flow. I could be the specialist in Apple. Nobody's going to route 5 lots to me because I don't control an order flow relationship that has the ability to decide what exchange those 5 lots go to. Exchanges will say they review these. I oversaw that process myself for years at NYSE. Ivan's done it. Kevin's done it. There's a massive incentive among exchanges, no matter where the best intentions you have in fostering liquidity, to ensure the big guys have these specialist seats. Because if you give it to somebody else, you're going to lose flow. By the way, you might lose flow as an exchange in a different symbol, not the one for which you're giving away the specialist allocation, because the big order routers know they have that leverage over you as an exchange. Yeah, not a good rule. I would say it just doesn't make any sense. Last point, sorry. I don't think exchanges can fix this on their own. I don't think competition is going to get you there because Kevin's got an incentive. He wants 5 lots, and he could say, I'm going to do the right thing. I think this rule creates perverse incentives and is not an appropriate reward for the amount of marginal liquidity actually being provided. So I'm going to get rid of my 5-lot rule. Are you going to do that unilaterally? You're not, right? Because okay, all those 3 lots and 5 lots and 1 lots and 2 lots are going to go to a competitor that says, you know what, I think I'm going to keep my 5-lot rule. I like this order flow. So this is where, and Commissioner Peirce used the phrase earlier, a gentle regulatory nudge or a friendly nudge from the SEC, I think would be incredibly valuable. If I were to get to, respectfully propose a change, I would say 5-lot appointments. The 5-lot aspect, I've conflated this a bit with specialists and DPMs, but the 5-lot entitlement specifically should be limited only to the most illiquid classes, for example, the bottom 20% of classes by volume. It should be subject to rigorous annual review using metrics other than the market maker's volume, by the way, because volume is self-fulfilling. If you're the specialist and you get all the 5 lots, your volume is going to be higher than anybody else, almost kind of ipso facto. So other metrics tied to liquidity provision should be required to be satisfied to keep those appointments. And there should be an expectation of mandatory reallocation every couple of years to prevent these things from being locked up forever. Sorry for the passion, but I think this is an important issue and one that it would be great to get right.
So I think Kevin's name was invoked, so we have an opportunity to respond.
Sorry, Kevin.
In some ways, I'm almost going to agree a little bit because you mentioned that, traditionally, or in the past, this was needed on the less active names where they're worse in a good market. In today's world, the market may not need help on Apple, Tesla, and NVIDIA, but NYSE, Amex might versus CBOE and NASDAQ. So it's an incentive program. We have any number of incentive programs across exchanges, across asset classes that we use. This is one incentive program. Like I said before, we realize that if you don't handle it right, it could actually limit competition on your exchange. We feel like more competition on our exchange, that makes our exchanges more competitive relative to other exchanges. So we have been looking at it. We've changed the process since your time. So we've tried to update that a little bit. But we do view it as a valuable incentive that we need in a competitive landscape.
I guess I get to bring it home. I'll try and economize my comments. I think foundationally, right, like IEX, options markets function best when there's competition at the lit quote, right? And the lit quote effectively serves as the backbone of price validation that drives investor confidence and engagement, which is foundationally what we're all in the business of doing. As a technical matter, competition among specialists and market makers is shaped as much by market structure as it is by participant behavior. It is technically true. Guaranteed allocations reduce the portion of order flow that's broadly accessible to others. However, as some of the panelists have pointed out, that serves a purpose, right? There's a certain rewarding about obligations, capital commitment, service elements of clients, and being at the MBBO. I think the core question actually is one of calibration and balancing the incentives to further vigorous quote competition and at the same time reward that service that's being provided. I think if you look at like the 40% guarantee allocation, for example, that's relatively benign, right? Because still 60% is available to other participants to participate with. I think the question that's created the most debate is probably the small order guarantee, which I think is certainly more limiting in isolation. And it is true, it perhaps incentivizes specialists to direct more flow in general to a venue. But I think the point that I would make is that these dynamics, however, are at the single venue level. And in practice, we compete in a multi-venue ecosystem where participants can access multiple guarantees and other forms of internalization across multiple venues. And the cumulative effect of those guarantees stacking is that a more meaningful share of order flow is less broadly available for competition than 18, soon to be 20 venues would otherwise suggest. And rationally, that impacts incentives, right? If you have a lower probability of interaction and you're more likely to interact with toxic and not benign order flow, then you'll likely be less aggressive in your quoting and commit less capital as a result. And so I think from our point of view, this comes down to balance. A number of participants have highlighted the fact that specialists are a scarce asset, and that creates a distribution between those that have them and those that are new entrants. And so I think from that point of view, you have to look in sort of in a balance and coordination is like, are these broadly available to all participants? Is the level of competition that facilitates their assignment also commensurate? But whatever we do, it has to be done both holistic in scope and coordinated in application. Because if you eliminate or transfer the way one guarantee functions, it likely redistributes that activity to another venue or mechanism as opposed to improving competition in and of itself.
Andrew?
Yeah, I was just going to add a couple points and won't be very long. We're talking about this 5-lot and this allocation thing, but it's important to remember, and I think John mentioned it, a third of the exchanges are price time, so it doesn't apply there. and roughly 2/3 of the volume are spreads and auctions and other trading. So we're talking about this allocation on a very small portion, right? Marketable versus non-marketable versus complex. So we're talking about it's not the entire marketplace where this 40% is involved. And then just quickly on the obligations, there was a lot of conversation about kind of quote traffic and the massive multiplier of quotes that's being sent. I think that is probably an area where we could take a look at kind of what those obligations really mean. We've talked about the costs and the revenues and whether it's 60% or 90% or 99%. I think there is a situation where we could kind of look to see how those obligations pay off. Market makers and all of us here only have revenue when there's a trade happening. And so if you're on a quote that's wide and not on that quote, you have no chance of trading, which is not what any of us really are looking to do. So if we're thinking about where our quotes are versus where our quotes are required, I think that's an area where kind of the exchanges could possibly modernize their approach.
I appreciate Steve's passion. And there was a lot that was said there. I think obviously I won't respond to everything, but I think that a couple of points that have been raised. I think the fact that liquid issues don't need specialists because there's plenty of activity across from all market makers is just not true across all series. There are thousands of series listed in the most listed liquid underliers, and many of them don't have liquidity, and without a specialist, they wouldn't have liquidity. Also, I think just the argument, anyone is available to participate in new issues and can go and solicit for new listed underliers for those specialists. And so if they were in fact that valuable and the obligations were not as significant as they are, many more market makers would participate in that, and not all do. And one more point. Steve, and as Andrew said, price time venues, most of price time venues do not have specialist assignments. You could ignore all of this entire conversation if a market maker priced one tick inside the specialist, which those market makers are at a fee advantage versus a specialist in most cases. Those price time venues typically offer a higher rebate for market makers, whereas as a specialist, you're normally on a pro rata venue, you're paying a fee. You've also paid for the order flow itself.
Yeah, just a couple points there, if I may, and thank you for responding to that. Couple things. One, so you could certainly make the argument that it is appropriate, and I did, in less liquid issues to have someone who has a heightened quoting obligation in return for certain rewards. Sure, you could break it down at the month or at the strike level if you want. But I think it's pretty incontrovertible that the most liquid option, and again, slice it how you like, it could be by class, it could be by term, it could be by strike, but the most liquid options products in the industry do not need a special 5-lot allocation to a single party forever as an incentive to keep them liquid. With regard to the price time point that was made by a couple folks, what I would say there is, sure, there are price time markets. There are times when a specialist is not on the MBBO. And in those cases, of course, none of this matters. But just to put this into perspective, the reason I'm harping on 5 lots so much, these are, if you do the math, and I have, on behalf of a market maker that does not have order flow relationships and considers getting into that game, it pretty quickly becomes apparent that the value of 5 lots is extremely high. These tend to be the least toxic, non-professional orders. They occur in vast numbers, especially since COVID. They're very attractive to trade with. And incidentally, that is precisely why you hear various folks saying, like, hey, this is really important. We want to keep this. This is good for us. It's because it's important. So I think arguing that it doesn't actually matter that much is a little bit inaccurate. But even given all of those points, yes, sometimes somebody improves by a penny on ARCA and the specialists are all deprived of the allocation. Nonetheless, during the course of the day, there are, I don't know how many millions of times a day that a 1, 2, 3, 4, 5 lot is routed by a firm that has control of a router at an instant where they have a specialist somewhere that is on the quote, and strictly as a result of that legacy appointment from, in some cases, 20 years ago, that firm gets to trade that entire order. It happens every day in massive volumes. So I don't think we could really say that, like, well, somebody could, sometimes somebody could improve the price. Sure, sometimes somebody does improve the price. But it is still the case that this distortive allocation practice exists and is massively impactful to markets today.
Great. Wow. What a good first question. Okay.
Panel's done.
All righty. So staying with competition, directed market makers are a unique aspect of options market structure. They enable order flow providers to send an order to interact with a specific market maker, quoting at the best price, who may potentially be an affiliate, which can then facilitate internalization. What are panelists' experience with the directed market makers or other ways in which brokers might seek to gain market share? I know we've touched upon this already, but Steve.
Thank you, Arun. I have a somewhat unique experience with this because Interactive Brokers really started as an outgrowth of our market-making business. We had this market-making business and we built all this extra electronic trading capacity and said, wait a minute, the fixed costs are already in. Maybe we could use some of that to route it to our order, to our market-making books or our DPMs and get the 5 lots, et cetera, that kind of thing. And we've also uniquely walked away from a lot of this. And one of the things that you're going to hear from me pretty much as a mantra is it's always about what's best for the customer. And I think to some extent, best execution sometimes is good enough execution, not necessarily best execution. A lot of times you have to work hard to get the best execution. And what I'm going to say there is we have 2 models for our customers to choose from. One is light, which is basically in stocks, free trading and the stuff gets routed and pretty much hands off. And we have pro, which is basically we will use all sorts of proprietary algorithms to try to get the best execution for our customer. And the vast majority of our customers opt for the pro, meaning they see the price improvement, they appreciate the price improvement. So how does that come into direct routing? We will do it, but only if we can really feel that it achieves the best outcome for the customer. That can be measured in a few different ways. It can be done with price improvement. It can be done with markouts, markdowns. But in general, PFOF is nice if you're just going to, I hate to say it, be a little bit lazy about it and just sort of say, here you go, we'll take the payment for order flow. Thank you very much. But as a result, we tend to expose our orders to a lot of different counterparties. I know at least a couple of the firms on this panel, not specifically the people, have said, "Oh, can you please just make us number 1 on your list?" And we won't do that. And so I think it's not a bad thing, but it's not necessarily the optimal thing.
So the question of order preferencing is a perennial issue. For decades, we have been talking about what is the impact of order preferencing. A lot of that discussion has been in the context of equity markets. And I think if your regulatory question and your concern as a regulator is the question, how, if at all, does order preferencing impact market quality? How does it impact the quoted spread in an ostensibly quote-driven market? We have a lot of evidence over the years that we can look to as informative evidence from other markets. Not as much from the option market, but there's some pretty interesting research going back to when NASDAQ was not an exchange, but was a network of dealers that were quoting. And there's research on how preferencing impacts the incentives and the tendency of dealers to quote aggressively and the extent to which the dealer quote attracts order flow. I think it would be a good exercise for the staff to go back and look at some of that old research on NASDAQ and over the years. With respect to option markets, there was an interesting thing that happened in the early 2000s. Before that, option markets had a structure where a single market maker in the crowd would disseminate the quote for that exchange. And if a marketable order came in, there was a wheel or an allocation mechanism where any market maker in that crowd would share according to a formula. And then what happened? Well, ISE came in with a different model where any market maker could put their own quote in the spread, and they would only get the order if they were at the best quote, and they had a narrower spread than anyone else, and they got a huge amount of market share. And a couple of years later, all of the other floor-based exchanges changed their rules so that individual market makers could get their quote in the spread. And overnight, I was at the commission at the time, I looked at the data. Overnight, the quoted spreads on all the floor-based exchanges dropped significantly when you introduced competition across the market makers for narrowing the spread. So I think the lesson there is that the more an individual market maker can attract order flow by quoting a better price, that gives them an incentive to quote a better price, and that matters. The question becomes, to what extent does preferencing or directed order flow weaken or undermine that incentive? In theory, there's an argument for why it might undermine that incentive. Again, the massive amount of research in the equity markets suggests that there might be some effect there, but it's not. Perhaps it's not a major concern.
All right, great. All right, for our next question. Let's discuss the possibility of order-driven markets. Outside of the most liquid symbols, resting orders are less common for options than they are for equities, in large part due to the number of listed series. Nevertheless, maker-taker fee models and customer priority models seek to incentivize the posting of customer orders. Are there any impediments to attracting more liquidity adding customer options orders? What can be done to incentivize them? Andrew.
Thank you. I'll just start with letting Steve have a cup of his coffee and say that, the U.S. markets are, in fact, the envy of the world, and we've seen a growth that has been quite remarkable with our quote-driven markets. We've talked about kind of how many quotes are out there. I think the thing to think about is that market makers cannot control the concentration of the products that they trade or exactly how they trade. Aggregators are generally responsible for all the exchange-facing fees, so the distinction between lifting a market and posting a market may not even be fully apparent to the customers. Approximately half of all the single order volume is marketable, meaning customers are regularly receiving executions inside the posted screens on those other halves. Mechanisms such as flash and complex auctions allow customers to access liquidity without needing to focus on whether they are taking or posting in any given market. In addition, trading platforms may employ algorithms that initially post an order for a short period of time, but ultimately cross the spread if a timely execution is not achieved. So, yeah, the quotes are there to provide it, but I think the customers are kind of thinking about what I want to trade and at what price I want to trade, and aren't necessarily concerned with the exact execution style that trade requires.
Nathan?
Yeah, I think we largely agree that I think it would probably be misguided to think of customer posting liquidity as a vector for deepening the lit order books, just given the number of quoted series that there are. It's probably best most of the time to think of customer non-marketable orders as just a demand for liquidity that they're seeking a better price on, rather than actually an attempt to deepen the markets. There's no real fee structure that's going to incentivize a meaningful amount of customer liquidity on millions of option series at any given point. So I'm thinking of it mostly as just an attempt to secure better execution on a wider market when they're posting, rather than additive liquidity is probably correct.
Stuart, did you?
Well, if you measure whether the option market is a quote-driven market or an order-driven market by the number of quotes it disseminates, it's definitely a quote-oriented market. But I found an interesting numbers in the supplemental data that was provided by the trading and market staff. They had a couple of tables showing marketable orders, execution quality, and non-marketable limit order execution quality. And adding up the numbers in the rows, it looked to me like there was about 50 million customer orders that were non-marketable limit orders, and about 20 million orders that were marketable. So it's true that if you pick a random series and you look at the limit order book, it's going to be empty. Well, the median trading volume across options series is 0. So vast majority of the strike prices and maturities on many, many series, there's no customer limit orders there because there's no trading volume on that series. When somebody does want to trade, as Andrew mentioned, it's very common for them to trade by submitting a non-marketable limit order inside the spread. So that the price that's determining the trade occurs is not necessarily the quote, but it's the order. So in a sense, options are an order-driven market, not really as much of a quote-driven market as we say. So I think as the Commission considers possible policy rulemaking or amendments or anything like that, focused on competition across market makers, they should consider both types of competition. Competition to, quote, narrower spreads, but also structures that enable and encourage market makers to fill non-marketable limit orders inside the spread, as well as competition in the auction mechanisms that offer price improvement inside the spread.
Great, Steve. I'd hope to add a lot of fresh stuff here, but I got to say that most of what I was thinking was already said. The one thing I will sort of add is there is like an exception where it in some ways is almost order driven. Well, first of all, Stuart, I agree with you 100% on that. Wider markets, it becomes order driven because somebody establishes that I want to pay this or offer this. But there are, I think, in some of the most liquid markets, I'm going to call them quasi-market makers, who are in some ways, I can't really tell if they're quote-driven, order-driven, or somewhere in between, because in some ways they're sort of quasi-market making in the sense that they're posting tight, two-sided prices, which may or may not be order-driven, may or may not be price-driven, that mimic that behavior. So there's I don't know that I want to dwell too much on the distinction, because I think it becomes, certainly to Stuart's point, a sort of blurry topic at some level.
Great. All right, for this next topic, I spent a lot of time working on this one. Let's talk about competition in retail price improvement auctions. Price improvement auctions have a variety of different fees and features that assist an initiator in gaining a greater allocation of an order. There are fee differentials between initiators and responders that make auctions more expensive for responders. Auto-match allows initiators to match better priced responses, and breakup credits are given to the initiator when their order is filled by someone else's better priced order. Do these features, as well as potentially others, impact the willingness of other market makers to respond with an improved price to an auction? Steve again.
Well, I'm glad you invited me to speak on this topic. We are immense users of auctions. That's one of the ways that we believe we can best foster competition, and competition, we believe, gets the best price for customers. We do this through our routing mechanisms, and we route to over 20 different liquidity providers of whom we solicit auction responses from. So to the extent that there's incentives for using auctions, we take advantage of them too. And I thought that there were some great statistics in the paper that was presented. As spreads widen, it's in many ways the best ways to get customers best execution. Yes, and you don't need an auction if it's a penny wide. You don't need an auction on an at-money SPX zero-dated call. It's irrelevant. It does matter when the spreads widen a bit, and you could see from the paper how much more price improvement could be gained from customers by using this auction mechanism. So we've got our own statistics toward this, but I'm glad that a source like the Commission can prove this point for us to some extent. And so, right, I mean, if spreads were always a penny, we wouldn't have this discussion, but they're not, and there's plenty of good reasons why they're not across all items. But this is a topic we feel quite strongly about, and we advocate their use and use them heavily.
John Kinahan?
I think is a straightforward answer to your question. Like, if the fees matter to an auction responder, they definitely do. And fee differences between the solicited side and an auction responder, they're significant. And this is an extremely competitive industry. Fractions of a cent count. The difference between a highest tier solicited, the paired side of an order, and an auction responder are it can be a very significant amount. So again, from a simplistic standpoint, like if the idea was to make that auction more competitive, make it cheaper. Again, but I don't mean to harken back on my comment on the 5-lot topic, but that would have complications to it. It wouldn't be that type of change wouldn't exist in a vacuum. You'd see auction dynamics change as a result of it. But the simple answer to your question, yes, they matter.
So make it cheaper for the responder.
Yeah.
Okay.
So yeah, I think as it relates to auctions, it's probably a tale of two cities. Auctions are, as Steve pointed out, a critical tool to provide customers with meaningful price improvement opportunities beyond the display quote. And I think that's accomplished in a variety of ways, right? The ability of auctions to trade at prices that have greater granularity than their quoted MPV, and the fact that the auction is in fact broadcast to all participants who potentially want to provide price improvement. I guess if the room's willing to indulge me a little bit on the nerdery of the auction, though, if you think about a typical retail auction workflow, it's going to be typically a customer initiating paired with an away market maker, right? And economically speaking, if that's a customer, that typically is zero fee. There's a contra fee that's generally anywhere around a nickel, high single-digit pennies, but that participant oftentimes is tiered and is subject to a customer rebate as well. So what looks like a 5-cent charge is probably a 7 to 12-cent credit, depending upon the exchange. And that happens irrespective of whether the order is interrupted or price improved or not. But in the circumstances when the order is price improved by an unrelated party, the portion of the trade that is broken up, there's also a rebate that's received on top of that. So if you take a look at initiating fee plus initiating credit plus the breakup rebate in relation to a participant that's price improving and probably paying 50 cents, for example, in a penny name, the difference there is well north of half a tick. And so from an intellectual point of view, one could argue that likely would frustrate someone's ability to be as competitive at each price point because of that variance in economics. Now, I think none of this can be done in a vacuum, and perhaps that does create a structural impediment. So things that we could think about doing is sort of rationalizing that differential. You could also take a look at it and say things like auto match potentially could also frustrate competition in one way, shape, or form. The thing to think about from that point of view, though, is that whatever we do, again, just like 5 lots, also has to be coordinated and holistic. Because if every exchange that operated a price improvement auction eliminated auto match, for example, except for one participant, one exchange, then a lot of flow would go to that one exchange. So I think those two things have to be obviously, balanced. And I think the fact that the Commission has this data to study where it is appropriate to leverage price improvement auctions, as Steve talked about, most liquid names perhaps not, I think that should be taken into consideration in light of some of these other suggestions.
Nerdery is a great word. Go ahead, Steve.
I was going to say the same thing. Thank you. Always trust Ivan for the best nerdery. Meant as a compliment.
I'll take it.
First, I like the way Steve kicked this off. I think auctions are a great market structure, highly appropriate for the options market, where we do have a less natural confluence of buyers and sellers simultaneously than could exist in equities. There's often an opportunity for price improvement. The statistics bear it out. It's great that we have them. It's an excellent boon for the ultimate customer experience. Always an opportunity to improve design. Again, I would look to competitive dynamics. Ivan and John both spoke a bit about the fee disparity that exists, and I agree with the points that both of them made. The design of auctions does strongly and intentionally favor the party that initiated the order flow. Building on some things Kevin said earlier, certainly full disclosure, I had a voice in the design of some of these mechanisms historically, so certainly have some skin in the game there. But I think that the incentives could be improved, so I'll build on Ivan's comment a little bit about AutoMatch is the topic I wanted to focus on. So just a reminder for everyone, or those who may be less familiar, the way that AutoMatch works, we call it AutoMatch, there are different names for it, but typically the egregious example would be the market on the screen for some option is $1 bid at $2. A customer comes in and is willing to pay 99 cents in some option that trades in penny increments. The initiator says, okay, I'll sell it to you at 99 cents, I'm going to start an auction. Somebody else could respond to that auction and say, I'm going to sell it at 50 cents. The initiator has the right to automatically have their price updated to 50 cents. So they get to participate on the auction, and uniquely, they're the only party that has this entitlement by automatically matching response prices. It pretty obviously diminishes their incentives to provide the best price out of the gate. I think you could argue a better market structure would likely be one where all participants had the maximum incentives to show their best price, rather than sort of waiting for someone else and saying, well, if he does, then maybe I'll do it too. So that's a skewed incentive. And as Ivan said, it's competitively very difficult for exchanges to move away from this incentive, because once it was existed on one market, it's a powerful incentive, again, for parties that control the routing of flow to go to that market in cases where they have a desire to interact with that order. So overall, would recommend a review of whether the auction incentives for initiators, both pricing and allocation advantages, are appropriate to the unique value provided by the order initiator, with a particular focus on, in my view, AutoMatch is kind of the most obviously distortive thing in that family of incentives that impact an otherwise very good market structure mechanism.
Could I just ask a follow-up on auction? So we talked about AutoMatch, we talked about pricing. Are there any other details, sort of data connectivity, frequency, timing, that we should hear about as we consider?
I think one thing kind of related to that and the timing and the AutoMatch is the aggregators or the committed party is starting that auction 100 milliseconds before it actually trades on the exchange. So on the AutoMatch, that is a large discrepancy, certainly in some of the, fast-moving products. And so these auctions, unlike some of the other trades, if a quote moves or someone, doesn't, cancels an order, auctions are almost guaranteed to trade. They're nearly 100% of those things trade. And so I believe that AutoMatch and that 100 millisecond timer, those offset because the aggregator is adding liquidity and or adding price improvement. And, you can have a market that's, 110, 2 up, and you could start an auction for 100 in order to provide extra liquidity and extra kind of price improvement. I think the move from blind to non-blind was a positive move that you mentioned. I think that's where I would be.
Yeah, I think align a lot with what Andrew said in terms of evaluating the length of an auction period. The initiating market maker is at a disadvantage when initiating an auction, given that they're committing to provide that capital 100 milliseconds in advance. So I think the ability to respond by auto-matching does take into account the fact that the market's moving and other market makers could choose to participate or not, and that initiating market maker may want to change their price and match. I think overall, though, just we are open to evaluating price improvement auctions, and I think it is worthy of a review. They are the primary mechanism to provide price improvement for retail orders, so I think that's a very important. But it's worth evaluating whether or not they've their use has changed versus what was originally intended. And then just quickly to touch on the pricing mechanics, I think agree with all of Ivan's math in terms of the overall fee structure. I think the one major exception there or outlier there is that it didn't take into account the payment that was provided by the initiating market maker to take on that risk and bring in the retail order to the market, which offsets all of the fee differential that's been raised.
Yeah, sorry, I was going to.
I was just kind of following up on fees, and I kind of concede some of the point of AutoMatch and how it could be tough for an exchange to try to buck the trend there and gain share. But on the fee structure especially, that's not an SEC rule, right? That is, of course, where the market is right now. But again, with 18, soon to be 20 exchanges, I think there's a lot of room for innovation. And if there are better ways to do it that would result in better outcomes for customers, I think given the the involvement of so many firms handling customer order flow with exchanges, either direct ownership or just even good relationships, there's a lot of opportunity there to come up with a new mechanism outside of SEC rulemaking.
I do think you could take that timer down. I remember when it was 3, and then it went to 1, and now it's 100 milliseconds. You could easily make that 10 milliseconds, and most of us are using electronics or computers to respond anyway, and so the difference between 100 milliseconds and 10 milliseconds wouldn't change much.
If I just may, I don't want to quibble with some of the ideas for improvement, because yes, we've steadily taken down the amount of the timer, but the one thing I will say is, I can understand the need for improvement, just don't mess this up for the customers, because the data shows, and your data showed this, and your colleagues' data showed this, there is a lot of price improvement here, and make sure that is, however we do this, just make sure that price improvement quality does not diminish as the rulemaking may evolve, please.
Well, it's investors' data because it's from CAT, and I can't miss an opportunity to point that out. But Steve, I did want to ask you, it's fascinating that most of your clients choose Pro from Lite. So when you quantify the benefit of using auctions and doing the nerdery to optimize auctions, what does that look like vis-a-vis your Lite clients, if you could say?
The numbers exist. I don't have them at my fingertips. It's meaningful enough that they're willing. It's greater than the amount that they would save by just routing orders. I don't have. I should have brought that number with me as a follow-up. I don't have it, Jamie. I'm sorry.
Am I allowed to say I use Pro, but not for options?
There you go. And other panelists
Now
have
he
told
will.
me that as well. Other people in this room have told me that as well. So there you go.
All right. For this next topic, let's talk about another execution venue, the trading floor. What's today's use case for physical trading floors for multi-list options?
Sure. No, no problem. So when we look at our floors and look at the activity there and talk to the users of those floors, both the market makers and floor brokers, and also all of the upstairs users of those services, what we generally see and what we generally hear is that the floor is handling larger, more complicated orders where electronic execution either isn't ideal or may not even be possible, at least on certain venues or through certain pipes. So this means a lot of multi-leg, very large orders. When we looked at our data, 75 to 80% of everything that happens on our floor is some sort of multi-leg or tied to stock type of trade. So these are not just simple outright trades. There's a lot going on there, and we've heard from several upstairs users that having that extra set of hands on that order at the actual point of execution can provide just an extra layer of really risk management and allows the folks on the floor to focus on getting the last bit of the execution done. Those upstairs sales traders can focus on what they're doing and working with their clients. So it's sort of a helpful bit of the ecosystem for them. And when you think about what would the alternative be, handling some of these large complex orders in electronic systems, it can introduce some risk, but also just can introduce additional fees or burdens. So you would have to build or buy or use algorithms to execute these orders. And in practice, many people are doing a little bit of both, using both the floor and electronics. But we kind of hear that there's still like a nice use of the floor for some of these larger ones where there's more risk involved. In terms of competitive dynamics, one thing we've seen on the floor is certainly a mix of how many orders come to the floor with kind of the order already matched versus not. And I think there's a perception of some people that everything that comes to the floor is matched, and we don't see that. We see some partially matched, and we have some segment of flow that is coming to the floor really looking for the floor market makers to provide liquidity. It's totally one-sided. So there's sort of a lot more going on there than just paired orders coming down and sort of getting printed on the tape. And there are kind of just one last point on the electronic side of things. There are a lot of electronic mechanisms, some auctions to some extent, that are trying to replicate some of the interactions or benefits of the floor experience. And we've seen, in many cases, sort of modest uptake, right? The market has grown tremendously. The floor has not grown at the same pace as overall options volume, but it has sort of more or less kept up. It's losing share overall, but it hasn't disappeared yet. The competitive dynamics haven't pushed it away. So I think over time, as electronic tools, if they were to get better, if they were to adapt more or be adopted more by the industry, we may see the floor lose share sort of more organically, sort of like we saw in the equities market where the market kind of moved beyond the floor. We haven't really seen that yet, and I think we may see it in the future, but I think we'd rather let the market decide that than any sort of exogenous force.
Go ahead, Andrew. Sorry.
A few years ago, Susquehanna submitted a comment letter recommending that all trades be exposed electronically. At that time, there were 2 fewer trading floors, and we continue to support that position today. In the current environment, we believe that electronic exposure, where any interested participant can respond, will result in better and fairer executions for the end customer and provide fair access for the entire trade. Floors are attempting to recreate the electronic auctions, but we believe they are doing so less efficiently. Price discovery for block-sized liquidity is overwhelmingly achieved upstairs before a block is presented to an exchange. Because the floors almost never price improve on an exposed block order price, but merely rather seek to participate at the proposed cross price. This is not adding liquidity, but rather taking it while providing little market value. A modified approach could include establishing a minimum size for floor trades. There are already electronic restrictions in place for solicitations and QCC trades. For example, a requirement that any trade under 500 must be exposed electronically would help ensure best execution for the majority of retail trading while still allowing trading floors to provide pricing and liquidity for larger and more complex trades. Lastly, we believe that any type of clean cross rule would go against all of these points, and it would block participants from possibly providing better prices.
I think every time I hear this question, my first question is, well, what are we going to replace the floors with? And I think Andrew brings up the idea of creating an auction mechanism to expose this types of order flow. I think we'd have to think very carefully about how that auction mechanism gets structured, but it could theoretically work, and I think that it could be viable if done correctly. If the alternative is to just close the floors and allow that type of order flow to be clean crossed, or even an expansion of kind of the ideas behind QCC, I think the industry should be very wary of that. I think with all acknowledgement to the role that like brokers and solicited market makers and facilitators, with acknowledgement to the role they bring to the marketplace needs a check. And I think the role of the floor right now is to provide that check.
We have those mechanisms, though. AIMS and pixels and PIMS and all of those would just work. You can't just put those in electronically.
Understood, but they don't get used in that fashion today. And things may change between where we sit today and that world where they get used.
So we have a unique perspective on this. We have one of the largest institutional market makers in options, and then we also have participation and presence on all of the options trading floors. And I think with that view, it's unclear to us that the options floors continue to provide the benefit that they once did. I think if that's evidenced by COVID, when all options floors closed, we saw an improvement or an increase in price improvement versus price improvement on the floor. And I definitely would welcome the SEC to study that further. I think the data that was provided today was interesting, but looking at the subsegments of equivalent activity executed electronically in an auction versus on the floor and what price improvement looks like would be beneficial for the market. We do have specific concerns around the floors as well. So there are a few activities that warrant review. We see internalization of small retail-sized orders on the floor as a major issue. Orders being shopped around floors to minimize participation is a major issue, as well as exchange policies that are intended to limit market maker participation is a problem. So I think, with that, similar to what Andrew said, we're supportive of looking at mechanisms to migrate activity away from floors into electronic mechanisms. That could be done through a cap, such as a 500 contract, or a minimum threshold, such as 500 contracts, and kind of start there. I think as others have said, and I think as maybe all of the panelists will likely say, a clean cross rule would certainly be problematic, and we would caution the SEC in considering that. I think as the SEC has done in all of their rulemaking, evaluating the impact to displayed price discovery with approvals of certain orders or of certain new mechanisms is warranted, and that would certainly be the case if you were considering a clean cross rule.
Yeah, I agree with most of what's been said, in particular with almost everything that John just said. I think you could make a case, I'll just mention this because I don't think anybody else has, that in single list products where there's a natural liquidity concentration on a single floor, for example, SPX, there are others, you could make the case that that's a reasonable process. You're going to bring an order to a place, and that is where the liquidity is, and that is where the market makers are, and that actually does provide some pricing benefit to investors. But focusing then mainly on the multi-list products, which I think is what the most of this conversation has been about. Just kind of a note on the structure. Floors right now, as I see it, really exist in sort of a regulatory inadvertent gap through the confluence of three things. We require orders to be exposed in the options markets in almost every case, with very limited exceptions like QCC, which I would also not want to see expanded. We count announcement on a floor as exposure, just like laying the order down electronically. And liquidity-seeking orders don't ordinarily go to floors. So almost everything of note that goes to a floor, I think, candidly, even if it is looked at on the floor as being liquidity-seeking, it was already shopped upstairs. And if they didn't find the other side, it's because nobody cared at the price. It's not because the floor is providing additional value. So electronic markets are extremely efficient. So basically, the only reason that orders go to floors is when someone is looking to internalize a big cross. And it's become very obvious over the years, and I don't think anyone will disagree, those orders tend to go to the floors where there is the least friction, tends to be, I think, the term of art. Those orders are seeking low-friction crossing opportunities. Yeah, I'm getting some agreement up here. So what happens on the floors is market makers have to spend money to put people on floors so that when an order goes to that floor seeking a low-friction cross, there is an opportunity to potentially participate, maybe provide price improvement, but typically I think most of that price improvement, again, happens upstairs. And exchanges then, through no fault of their own, and I've been in this situation as well, again, exchanges have an adverse incentive to compete for flow by making the floors as frictionless as possible. And that is every exchange about potentially getting more volume on their floors is always about how can we make this quicker and easier and faster and less likely for there to be those annoying market makers who get in the way of these crosses that we want to be able to print on our floors. What does not happen on floors is price discovery in multi-lists. It's just not happening. So for the vast majority of orders, I would certainly agree with Andrew. By the way, CTC, my former employer, also signed that letter, if we're talking about the same one. It was many years ago now, I think. But certainly would recommend that for the vast majority of orders, mandatory electronic exposure should be the goal. I don't think we need to let the perfect be the enemy of the good. If I were to humbly make a recommendation, it would be that the SEC should signal a moratorium on approving additional trading floors. As Andrew said, the number of floors has grown after many years of stability, first with Box, then with Miami. We do not need any more. But if the regulatory position continues to be that it's okay, floors are a perfectly cromulent place to trade options, then inevitably IEX and MEMEX and the Texas Exchange will open floors in the next small number of years, and I think that would be to the detriment of market structure.
I'll just add that we're going to focus on launching first, not so worried about the floor.
All right. So we recently had another roundtable to discuss the trade-through rule for equities. But options are not governed by the Reg NMS trade-through provision, but rather by an NMS plan. Is a trade-through restriction still appropriate for options? Katie.
Yes, one of my favorite topics. So I'll go back to my comments at the beginning. Again, options differ from equities. Big one when it comes to trade-through is there is no off-exchange trading, right? So if the original intent of the trade-through rule was to ensure that investors are getting a great experience, well, let's look at that. We've already discussed, and I'm going to be the person who says it the second time on the same panel, but retail has never had it better. So they're being served very well. If you think about the institutional side of the concerns around executing large orders, I know we just had a healthy debate about floors, but they do have a floor option, and I'm sure if floors were to go away, the creative minds up here would find a way to service that customer set well, as just as retail is served. So I'm also going to go back to my beginning comments about that equation with the revenue opportunity, but also the cost side of this. And this is where options is similar to equities. So any removal of the trade-through restrictions is not going to guarantee that the firms sitting up here are going to be able to disconnect from exchanges. It may not alter the cost side of the equation. So the question becomes, and not just on this particular one, but sort of what we're getting at all day, to kind of sum it up, is what is the problem we're trying to solve for here? And what results would we anticipate would come from any changes we would make to market structure? And then how would we measure those results if we do implement changes? And then what would be our plan to adjust accordingly as we continue to monitor the environment as it changes? And I think John was kind of getting at this. What if we make it worse for people? So I think that's just sort of my way to end. This is my last segment today to speak on, so sort of the end for the day. Again, what is the problem we're trying to solve for before we come up with any changes, even though I know Jamie and Richard have made it clear this is more of a discussion rather than a rulemaking today, but just to end with that.
I mentioned earlier that non-marketable limit orders are sort of a crucial way that customers can obtain better prices and price improvement relative to the spread in option markets. And I think one thing that facilitates that is the display rule and the trade-through protection that they're given through the option linkage plan. One of the explicit stated goals of the national market system is to seek to allow, where possible, public orders to interact directly with each other without the need for intermediation of a dealer. That goes back to the beginning of the national market system. And that may not happen a ton in option markets because it's so fragmented across so many series that there's often dealer intermediation. But the trade-through protection in option markets feels to me to be very consistent with the goals of the national market system in empowering investors to get their limit orders executed by getting them displayed and having them protected. My understanding is the exchanges have already sort of hard-coded into their rules and into their routing logic the ability to reroute orders to where there's a better price. So I think it's operating pretty seamlessly is my understanding. But.
Thanks. I'll follow up on one thing Katie said, the cost line of this. And I think this is probably similar between equities and options, in my opinion, that if you were to introduce some sort of change to the approach today of all exchanges have this protected quote, I don't think a lot of exchanges or any exchanges go away, and I don't think costs reduce. But I do think looking to the future as we keep, there's certainly an incentive to keep adding exchanges. And I think you have to think about how do you handle the upside or the growth in costs, and we're very cognizant that fragmentation is a bit of a cost for us, but I think it's much more impactful to most of the other folks up here. So I think it's worthy to ask, is it right to have a protected quote and an obligation to connect to a venue on day one of that venue, or do you need to have a proving ground or a proving period? And we haven't really seen this approach in options, but in equities, we've certainly seen ATSs start, go from zero to something substantial as an ATS and then become an exchange. IEX obviously followed this path very successfully. And the market structure is different, so it's not a perfect analogy that it could necessarily happen that way in options, but I think there are kind of things that are worth thinking about if you need to clear some hurdle for the protected quote or to Citadel's points that they've made to get the protected quote and or abilities to charge for certain products. Maybe that should not be sort of open to anyone who gets the filing in and starts an exchange from zero.
Yeah, if I could just add on to that, it goes back to what I did in the beginning where I did that 1% market share threshold. And in equities, you've got 7 of the exchanges are under 0.5% market share. Yet you're right, Kevin, from day one that they open a door, they're collecting market data and connectivity fees. And that's one of the things that I would put on the list that a question we should be asking. How do we stop that?
Yeah, I think just to expand upon that, I know I mentioned in my opening the 200 million estimate for the impact of the industry from small venues. I think, yeah, the exchange proliferation is a major cost to the industry. You know, we're at 18 options exchanges with 20 expected by the end of the year. So a lot of that is driven by the benefits to launching an exchange. So there's ORF, which was discussed earlier. There's fixed connectivity and data fees as well. And so we did an analysis to look at, you know, how do we come up with this 200 million number? So we looked at all venues under 4% market share, which in options, given everything trades on exchange, that's a slightly different number than what we've used previously in equities. And we looked at the ORF they collect, as well as our estimates on the connectivity and proprietary market data fees that they charge. And that number is substantial. It's a major cost to the industry. I agree with the other panelists that simply changing a trade-through rule wouldn't address this cost, given that most industry participants are already connected to these venues. And as an order router, to fulfill best X obligations, you likely need to continue to connect to those venues. So I think the potential solutions that we've proposed previously are, evaluate a market share threshold for participation in SIP revenue, evaluate a market share threshold for exceeding certain connectivity and market data costs as well, which we hope should curb some of this exchange proliferation.
Okay, I think the fact that all these exchanges have above 1% of the market share, I think we should treat as evidence that they are actually serving a real purpose here. It's not just de minimis, and to the extent that we've already talked about how the reforming ORF has decreased at least some of the sort of unnecessary cost of proliferation. But if you want to look at why is there this incentive for the new exchanges, and part of it is to go back to our first topic, that they are serving a real market need of a more competitive specialist allocation process, and so having that process be more competitive and more ongoing, I think would at least reduce some of the artificial incentive that currently exists for those new exchanges.
Yeah, and just for the numbers from John's comment, but for the below 4%, when I pulled these data, it was 9 of them are below 4, and then there's a 10 that's like right at the 4%. So almost half are below your 4% number.
One quick point on John's point about the best X. I do feel like if you did something where exchanges under 4% or 3% were not considered protected in the options market, I don't actually believe it would impact the prices that the customers achieve, because I think the customer firms are evaluating whether it's EQ or liquidity, and so whether that 17th, 18th, and 19th exchange is at 109 or not, I don't think actually changes kind of how that execution would happen. And then one other one to John is that there are massive fixed costs too. I have a feeling that might be in your 200, but you didn't say it, so pointed out, the connectivity, data center, boxes, cross connects, all of that are a real burden when you start to go from, what was 5 exchanges to now 18 and soon to be 20 and I guess 21 soon.
As a former market maker, I will say that is probably the biggest impediment to having new market makers come in. There's a big cost. There's a big cost to starting a market making firm, and that's not shrinking. So,
and yeah, to speak to the numbers too. So yeah, progress has been made with ORF. In our estimates, ORF was 25% of that $200 million number, and agree with Andrew, the fixed connectivity costs are a major portion of the number.
Yeah, and just to Steve's point, that was what I got at in the beginning. Like, I think a very important question here is, have we made the ante way too high for new participants to come in, or even people to remain in the business, given all the costs in the industry?
So got the sense there are a couple of sellers of a QCC up here. Anyone want to take the other side or argue the counterpoint?
Sorry, it's a QCC?
Yeah, the qualify the
yeah, no,
exemption.
Okay. I think, the one thing we are, I guess, cognizant of, and QCC to me is part of it, is, at this point it's kind of been brought up a couple times over the day on a couple different things. it's great, I think, that the options market has order interaction, and obviously QCCs are different, but providing tools like that where overall the market is focused or sort of biased towards exposing orders, allowing market participants to participate is great, and I think far better situation than the equities market where so many orders, retail orders, institutional orders, you name it, are not exposed to an exchange and are not really broadly available for trading. So, I think QCC is helpful in the sense that, broadly we're still keeping this exposure. There's a carve out for a particular type of trade. Certainly understand, concerns if it were to be, expanded or a clean cross type order type introduced, obviously people would have concerns with that. But, overall, I think maintaining tools that allow the ability of most orders to interact in the exchange world is a positive thing. So it's something we think about how in terms of that particular capability.
All right, for our last question today, and it's been a great panel. Finally, for our last topic, we are going to talk about liquidity, specifically quote width. Outside of the most liquid symbols, quotes seem to be wide and getting wider. What could be done to facilitate tighter quotes? John.
Yeah, I think a key question to ask there is what aspects of market structure create excess complexity and cost for market makers, and ultimately that results in wider quotes. So we think there are a few areas that are worth evaluating there. One is capital frameworks and the fact that they're not always sufficiently risk-based and evaluating the full risk of your portfolio. Within that, I think there's alternative net capital rules and their availability to market makers is an issue worth evaluating, as well as allowing model-based risk controls as part of that. Also, clearing fund methodologies or clearing fund allocation and margin methodology is worth evaluating, to ensure that they're better risk-based. Strike proliferation, which is an issue that has come up today, is another issue that impacts market makers and ultimately results in wider quotes. I think roughly half of options series have zero open interest. So there are nearly 2 million strikes, and half of them have no open interest, have never traded. And we also think, as said earlier, worth evaluating auctions. I think they are, again, they clearly are the main mechanism to provide price improvement to retail investors. But at the end of the day, if it's deemed that they are resulting in wider quotes, it's worth evaluation.
I can just expand on some of those ideas. You think about what it means to be an option market maker and how options are different than stocks. I mean, Katie mentioned some of the things. One important way in which an option is different than a stock is that an option market maker is quoting 100 or 1,000 or multiple thousands of different series on the same underlying. I looked the other day, I think Apple has 3,200 different series, over half of which did not even trade on the day I was looking at it. And the option market makers have exchange obligations to maintain, most of the time, two-sided quotes on all of these series, and then there's other market makers on other exchanges quoting those same series. And any time your spread on any one of those 3,200 series is going to cross with some market maker on some other exchange, there's someone out there who could pounce and try to do an arbitrage against your two quotes. Or if your quotes are stale and not updated frequently when the underlying market moves, you're subjecting yourself to arbitrage. So there's sort of a question of what is the optimal width of your spread that you're going to quote on thousands of series that never trade, given that it's costly to update. You have a complex model-based system that you're updating the parameters of to run your auto quote system. And does the commission want to strongly incentivize market makers to aggressively compete on narrower quotes on series that never trade? How much resources do you want to dedicate to that. So if that's the reality, then as you think about what type of competition do you really want to focus on, I'm not saying it's unimportant to consider encouraging competition across quotes, but it becomes more important to really ensure that there's robust competition after an order arrives to allow market makers and other market participants to wake up and say, oh, somebody actually wants to trade this option. How much price improvement can we get? So focus on the auctions, focus on what effects does exchange proliferation have on the ability of market makers to offer price improvement to marketable orders, perhaps other ways of focusing the competition rather than imposing additional risks and costs on market makers for quoting series that never trade.
To follow up on that, would a periodic or one-sided auction be useful?
One-sided quotes, you mean, or
One-sided auction. So an auction would just start, and then if someone wanted, so it wouldn't need a market maker to start the auction.
Go ahead, Andrew.
I think that would hurt the displayed liquidity. It would hurt the prices that are shown on the screens. And I think you'd have potentially even wider screens in a way, because those quotes are out there. And to Stuart's point, the one thing I would add is that those 3,000 quotes have often very, very correlated risks too, right? If the Apple stock moves, and they're, calls and puts deltas. But no, I think if you did that kind of open auction, you'd potentially hurt the screens even more, and it'd be very hard for investors of any type to understand what the kind of pricing of that option is. You could just imagine a world where like an entire expiration in Apple could go, no bid at 50, and there'd be no sense of what the volatility is or what the real risks are, because it'd be kind of no trade on those quotes.
I'll answer the question and get to my point if you don't have a follow-up on that. Is I think it's important here to realize that there is a disincentive for market makers to quote too tight, and I think we don't want to further disincentivize them. To John's point, if there's one of the things that I've thought about for years is I know strike mitigation has been a topic forever. But if we still have 1 million out of 2 million strikes that have no open interest, I will argue we have too many strikes. And from a market making point of view, I understand this because I did this plenty, is you can't put your best foot forward on every strike all the time. It's impractical. And, and especially now that, the statistic was what? We went from 3,400 to about 8,500 quoted names. Each of them have multiple strikes. Do you want to be moving high delta options? Do we want to, at some level, you're just increasing more quote traffic without a lot of benefit. So I do think that's important. And what we do is we use the auction mechanism to mitigate that. Beyond that, we actually basically have market access controls that prevent customers from trading off of too wide of a spread. We to a certain extent, we won't put in an order if it's too wide of a spread. We will seek liquidity at a better price for them. And part of it is also education. At any given point, we pretty much know what the fair value is of that option, even if it's a wide spread. It's not always, the wider it is, the harder it is to determine. But in any given case, you can pretty much figure that the midpoint is the fair value as far as the street is determined. And we go to a great extent to educate the customers to say, look, here's the fair value on this option. It's, let's say it's 10 bid at 20. Okay, so, you're probably not going to get it if you bid 15, but try 17, try 18. Odds are one of these guys here will hit you if you're above his fair value, and that's the way we try to do it. And so I think that it's a bit of an art as much of a science. I think a lot of it is on the brokers, because I don't know that we can rely upon the market making community and just the amount and just the pipes to manage. If we had tight spreads on every single line everywhere.
I think a question that is or a useful way of thinking about this question is, what are my incentives as a market maker to marginally improve some widespread in some illiquid thing? And what are the things that I would worry about that are disincentives to doing so? And I think several of them have already come up. John Fisher made the point a couple of times, which I agree with. Generally, and you asked about one-sided auctions, I think the response was a little negative. I would agree with that, but I would also say I think you could make all the same points about two-sided auctions, right? I mean, anytime you have an auction mechanism that allows someone to jump up and improve the price beyond the quote, in a way you're disincentivizing putting that quote up there in advance because it doesn't have a participation entitlement. Now, there's an important balancing act there. We want customers to get those better prices that they are through auctions as a market structure mechanic, but there is that risk. So am I going to improve the quote? Well, when the order comes in, someone's just going to start an auction anyway, and maybe I could just not improve the quote and respond to the auction, and then why am I sitting out there? Conversely, if I am sitting out there on the quote, I do have this risk that I'm going to get picked off by someone whose price feed is a couple of microseconds faster than mine. By the way, I think there is a solution there, which is allowing exchanges to be creative and having the regulators sort of stand out of the way as exchanges try to do interesting things. We supported, I shouldn't say we, my former employer supported the work that IEX has done along those lines with market maker risk protections. Other exchanges have looked at other things, speed bumps and other market mechanics that can reduce that pickoff risk. And then the third does get back to something that we spoke about extensively before, but it is the question of allocation. It used to be that, why do I want to improve my quote? Well, I'm on a pro rata market, and if I show 10 and then, an 8 lot comes in, maybe I'll get a couple, and that's a good order. I want to trade with that order. Nowadays, as I spoke about a lot previously, up to 5 contracts, I'm never going to see that order because whoever controls that order is probably going to send it to another exchange where either they or their affiliated market maker is a specialist and is entitled to trade all of it. And that's true even if I improve the quote, right? I can improve the quote, they can match it, and now they get the order. I never see a single contract. Why am I exposed to potentially lose on those more toxic fills? So a lot of issues at work there, but there are, I think a lot of the things we touched on earlier could help to improve the story about better incentivizing market makers to improve quote quality on screens in some of these less liquid products.
Can I just mention one thing on the strike mitigation versus the strike proliferation? I was on Lomswag, and it took a couple battles about the mitigations, and it didn't always go well. But I will say that there is a large amount of friction in adding the strikes kind of intraday when the moves happen. And so I think while we do have lots of strikes that don't have open interest, we have an environment that allows the customers, institutional or retail, to make the trades they want even when news comes out. So there is a balance between the two. I actually think that we've reached a reasonable balance. When the markets move 10% or 15% over a 2-week span, you kind of pick up strikes and there's not much you can do about it. But I think that there's certainly a friction of going too low on strikes because then that product is not available to trade, and that's real hedging costs and trading opportunity.
I was just going to say on the strike rationalization part, Steve and Andrew make a good point. This has sort of been a long-standing topic for a period of time. Ellen, Giganti, a number of folks on the listed options market structure working group have tried to tackle this. I would say as a practical matter, it's very difficult, actually impossible, for exchanges to actually coordinate on this particular matter, as you can imagine, for antitrust concerns. And so I think this is an area where some direct initiative from the Commission to help support a more intelligent strike regime and rationalization might be a very practical, application.
So floats like a butterfly, stings like a bee. Please join me in thanking Arun as moderator and these wonderful panelists.
And if you have more to say, or if our audience has some thoughts, the comments file is open.
So we're going to take a short break and be back here at 11:30, please.